for $100,000. For cities, for completely different real estate realities. $400,000 is a meaningful budget in most of the world's top cities. But what you actually get for that money varies more than you'd expect, even between Tokyo, London, Sydney, and Toronto, all for our developed market global cities. All four have strong rule of law, mature property markets, and foreign buyer access. But the differences in size, location, cost of ownership, rental yield, and long-term appreciation potential are massive. In this analysis, we break down exactly what $400,000 buys you in each city, the real numbers, the real neighborhoods, and the real investment case. Before we go city by city, let's set the benchmark. In each market, $400,000 translates differently. In Tokyo, the dollar goes farthest. The yen has weakened significantly against the USD, creating one of the strongest buying opportunities for foreign investors in decades. In London, the pound sterling means your budget is tighter, roughly £312,000. Sydney and Toronto are both denominated in weaker Commonwealth currencies, giving USD buyers a modest advantage. On pure square footage, Tokyo wins. On lifestyle value and rental yield, the rankings shift. Here's the full picture. Tokyo first, with a USD to Japanese yen exchange rate hovering near 150 for $100,000 converts to roughly 60 million yen. That buys you a solid one-bedroom or compact two-bedroom condo in areas like Shinjuku, Shibuya, or Minato-ku. We're talking 40 to 55 square meters in an established mid-rise building. Tokyo condos have held value remarkably well. The average appreciation rate in central Tokyo has been around 4 to 6% annually over the past decade. Gross rental yields run between 4 and 5.5%, unusually high for a global city. The cost of ownership is also low. Property tax is typically 0.3% of assessed value per year, and assessed value is set well below market price. For foreign investors, there are no restrictions on buying Japanese real estate. The key risk: Japan's declining national population. The opportunity: Tokyo's population is still growing, drawing urbanization from surrounding prefectures. London, at $400,000, roughly 312,000 British pounds. You're looking at the outer zones of the London Underground. Think Zone 3 to 4 areas: Stratford, Walthamstow, Lewisham, or Wimbledon Park. In these zones, you can find one-bedroom flats of 45 to 60 square meters, or occasionally a compact two-bedroom in a converted Victorian terrace. Central London, Zone 1 or 2, is essentially inaccessible at this price point. The investment case for London outer zones is solid. Crossrail connectivity and ongoing regeneration in the East End have pushed significant appreciation in previously overlooked areas. Gross rental yields in Zone 3 to 4 range from 4 to 5.5%. The major cost consideration: UK stamp duty land tax adds 3 to 5% transaction cost on purchase, plus an additional 2% surcharge for foreign buyers. Annual maintenance and service charges on flats can run £2,000 to £4,000 per year. London's long-term track record of capital appreciation remains one of the strongest of any global city, but entry costs are high and rental regulation is tightening. Sydney, at current AUD to USD exchange rates, $400,000 converts to roughly 620,000 Australian dollars. That's a meaningful budget in the current Sydney market, but still not enough to buy a house in most suburbs. Instead, you're looking at one-bedroom units in inner west or North Shore suburbs, areas like Parramatta, Liverpool, or Penrith on the outer western corridor, or compact one-beds in established inner suburbs like Redfern or Marrickville, where prices run higher. Sydney's median house price now exceeds 1.4 million Australian dollars, making units and apartments the only accessible entry point at this budget. Gross rental yields on Sydney apartments range from 3 to 4.5%, lower than Tokyo or London's outer zones. Capital appreciation has been strong historically. Sydney delivered 9% average annual growth over the past decade, though the recent rate cycle caused a temporary correction. The major risk: Sydney has the most stretched affordability of any city in this comparison, with a median price-to-income ratio above 12. The ongoing infrastructure investment in the outer suburbs and new metro lines creates medium-term upside for outer corridor properties. Toronto, $400,000 converts to roughly 550,000 Canadian dollars. In the current Toronto market, that's squarely in one-bedroom condo territory, specifically in the downtown core, midtown, or the Yonge-Eglinton corridor. A typical purchase at this price point gets you 500 to 650 square feet, roughly 50 to 60 square meters, in a purpose-built condo tower. Toronto built more high-rise condos per capita than any other city in North America over the past decade, and that supply has weighed on rents and capital values since 2023. Gross rental yields run between 3 and 4.5%, with carrying costs, condo fees, property tax, insurance, often consuming 30 to 40% of rental income. The investment case: Toronto's population growth is among the fastest of any G7 city, driven by immigration policy. Long-term demand is structural. The near-term risk: the oversupply of investor-owned condos, with nearly 1 in 5 units sitting vacant or underutilized, creates downward pressure on rents. Best positioning: pre-construction projects in underbuilt neighborhoods rather than high-rise saturation zones. Now let's put them side by side. On square footage, Tokyo wins decisively. You get the most space per dollar. On gross rental yield, Tokyo and London's outer zones are tied at the top, both around 4 to 5.5%. On total cost of ownership, Tokyo is the cheapest: low property taxes, no stamp duty equivalent, no additional foreign buyer surcharge. Sydney and Toronto have the highest carrying costs relative to rental income. On capital appreciation history, London and Sydney have the strongest decade-long track records, but both have seen recent corrections. On foreign buyer access, Tokyo is the most open, with zero restrictions. Canada has introduced a foreign buyer ban in some categories that affects new builds. Check current rules before proceeding. The UK adds a foreign buyer stamp duty surcharge. Australia requires Foreign Investment Board approval on purchases. In terms of currency tailwind for US dollar buyers, Tokyo stands out as having a structural advantage right now, with the yen at multi-decade lows against the dollar. Where would the smart money go today? For pure yield optimization, Tokyo, specifically central Tokyo condos in walkable inner neighborhoods. The yield is strong, the currency is favorable, and the regulatory environment is investor-friendly. For long-term capital appreciation potential, London outer zones are undervalued relative to historical norms, and the crossrail effect is not fully priced into some stations. For currency hedge value, all prices in USD. Tokyo is the clear winner while the yen remains historically weak. For population growth tailwind, Toronto and Sydney both have strong immigration-driven demand, though Toronto's condo oversupply is a near-term headwind. For the most straightforward entry, fewest regulatory hurdles, lowest transaction costs, Tokyo by a significant margin. One caveat: Japan has unique due diligence requirements, particularly around building age, earthquake resistance certification, and leasehold versus freehold title. Always work with a bilingual real estate agent who specializes in foreign buyer transactions. The verdict: if you have $400,000 to deploy in developed market real estate, here is the ranking. Number 1 for the current environment: Tokyo, central neighborhoods. Maximum space, best yield, lowest ownership cost, strongest currency tailwind. Number 2. London Zone 3 to 4, particularly post-Crossrail corridors. Strong historical appreciation, improving infrastructure, and a stable legal framework for landlords. Number 3. Sydney Outer Corridor units, specifically areas benefiting from new metro investment. Population demand is real, but yields are thin. Number 4. Toronto downtown condos, but only in underbuilt neighborhoods away from high-rise saturation. Immigration-driven demand is structural, but near-term oversupply requires patience. The overarching rule: in developed markets, the entry point matters more than the market. Buy below replacement cost in areas with infrastructure investment, with a yield that covers carrying costs from day one. Subscribe to Property Ranked for data-driven real estate analysis every week.